What's going on, everybody? Welcome back to the channel. I appreciate you stopping by, spending a few minutes of your time here with me tonight. I've actually got you down here at the bonfire with me. I've got a nice, cozy bonfire going lakeside. It's a beautiful night down here in Texas, man, and I hope that this video finds you well. All right. I wanted to take this opportunity to sort of follow up with you on what we spoke about in the last video, okay? Which was the idea that 98% of the candles on your chart, regardless of time frame, will have a wick on one or both sides, okay? Those wicks represent the high and low of the day. But another thing those wicks represent, okay, if we have a bearish candle, okay, then that upper wick represents a portion of intraday price action that occurs above the opening price of the day. Okay. And the bottom wick, the low of the day, represents a portion of intraday price action that occurred below the closing price of the day. Okay. Does that make sense? Now, also, in that video, I introduced the idea to you guys of facts, okay? Market facts, objective facts that cannot be argued, that cannot be debated, okay? They're non negotiable facts of the market, right? This idea, it's more than an idea, right? It's a fact that 98% of the candles on your chart, regardless of time frame, have a wick on one or both sides, all right? That is an example of a fact of the market. You can't debate that. You can go look at your charts right now, okay? Unless you change the type of, candlesticks that you're using or, something like that. I'm talking about if we're using basic candlestick charts, nothing fancy, right? Now, another fact of the market is that on any given day, we can expect the market to do one of three things, all right? We can expect the market to either give us a higher close than the open, okay? Or we could expect the market to give us a lower close than the open, or we could expect the market to give us a relatively equal close to the open, all right? Now, this is a very simple idea, okay? In my opinion, this is a very simple idea. You should understand this right away, all right? Now, even though it's so simple, it's a simple idea in the fact that, okay, we can expect any day to potentially give us a higher close, a lower close, or an equal close to the open, right? That's easy enough, but there's a million different ways that the market can put in a higher close, okay? That doesn't mean that it just opens and then just goes straight up and puts in a higher close, okay? There's gonna be a lot of ups and downs, perhaps, you know what I mean? There's a lot of different ways that each one of these scenarios can play out. But what I'm trying to do is point you to this idea, okay? Let's simplify your trading, okay? Every single day, the market can only do one of these three options, okay? That's it. There's nothing else that the market can do. It cannot give you a higher close and a lower close at the same time, right? It doesn't work like that. So there's only three things that the market can do on any given day. This stuff is powerful, even though it sounds so simple that you're going to forget it as soon as you click off of this video, right? These ideas are powerful and can seriously help you in your trading if you just sit there and think about these things and think about the implications. If what I'm telling you is true, what does that mean? Okay? And explore that for yourself. Now, I'm going to show you some real chart examples, okay, from Tuesday and Wednesday, okay, and sort of talk you through this sort of thought process. I'm going to show you examples of what I'm talking about and how you might be able to use this and how we might use it in conjunction with certain information from Stacy, like signal days, like the 3-day setups, etc. All right, let's synchronize our understanding. Now, here we're looking at this DJ30 chart. I'm going to show you the trade that I took in the London session on Tuesday. All right. But first, let's just look at the overall structure here on this chart. You can see we have a big box right here, this high and this low. This low, okay, if memory serves me right, okay, this low, this is our low of the month level. So when we are here, we are not at the low of the month per se, not literally, right? But we are trading back into that low of the month level. We are down low. We're not up high, right, on the month. We're down low on the month, okay? So we've had days right here that are closing lower than the open, okay? Now, you can see what I'm saying, right? This day closes lower than the open, right? The next day closes lower than the open. But look what happens, okay? When this day opens, okay, we have this first red day right here, whatever. We're putting in lower lows. We break the previous day's low, whatever. The next day also goes lower, gives us a lower close, but it opens, right? It opens somewhere up here, goes lower. Where does this market open? It's kind of hard for me to see here, right? And you can see we pull back, we trade back into the previous day's high and low range just a little bit before giving that lower close, okay? The next day gives us a lower close. You can see how it opens here. It trades above that opening price before going lower, trades back above that opening price one more time, reaching back into the previous day's high and low range before giving a lower close on the day, all right? So anywhere above this opening price is your upper wick, okay? And this tiny bit of price action below the closing price of that day is the bottom wick, right? And then you got everything that's in between, right? So I saw this that we're down here low, near the lowest price of the month. And then we have a first green day, right, on Monday, right? You can see it's the first green day. We actually break Friday's high, okay? And then close. We have our first higher close than the open after a series of downward closing days, okay? That first green day is a signal day, according to Stacy. And what does it signal, right? We're trying to look for a first green day follow through trade. So we're looking for a long trade the next day. So ideally, what we're saying when we're looking for a long trade is that we're expecting this market to close higher than it opened. And if that's the case, then the ideal place to buy into this market is anywhere below the opening price. Okay. So when this market opens, it trades below. Let's zoom in, right? This market opens here, trades below that opening price through Tokyo into the London session. All right, we're trading back into the previous day's high and low range. All right, and we're expecting a higher close than the open. So if we're below the closing price, right, eventually it should go above that closing price or that opening price before closing, okay, and giving us that higher close. So if you can buy anywhere below this opening price, you are getting a good price. You are buying low, right? And that is the name of the game. Buy low, sell high. Okay, so you are buying low. So when I saw this, I was at my charts, right, for this little capitulation into the London Open right here, right? So this London session here is retesting the previous day's swing low that also happened in London, right? The low of the day is really over here, right? But this London low, we're retesting that level. We can't get all the way back down there. The market puts in a little W pattern, okay, and then engulfs to the upside on the 5-minute chart. We're going to take a closer look at that. But I got in that market at the first sign, like as soon as the entry criteria is met, I got into this trade. I put my stop loss. It was a 1-bar stop, okay, not even at the low of the day, very tight stop, okay, like a 20 pip stop loss or something like that, right? And I targeted the previous day's high. right? Because that's what I know from Stacy, okay? Trading these parabolic trades. We're taking it from level to level, right? So if I'm getting in at the low of the day, I'm targeting the opposite side of the range or the high of the day, right? So I entered that market and then I went to sleep and I forgot about that trade. I forgot that I took that trade until I came to my charts on Wednesday morning for the New York session and I saw my account balance, right? And I was like, whoa, wow. Oh, yeah, I took a trade in that London session, right? I traded this trade like it was a demo account. I didn't even care, okay? I traded it with 100% complete confidence. And the reason why I was able to do that, right? Not only do I have, a little bit of experience, I understand, the program that we're trying to work with Stacy and all of that, right? And I also understand these basic market facts to a degree, okay? I've thought about this stuff, okay? Now, that's not the only reason, though. The other reason is I appropriately sized into this trade. Okay. I don't typically trade the London session, especially when we're talking about a US index, right? But if the setup is there, the setup's there, you take the trade. Okay. But because of that, and I knew I was going to be going to sleep, I wasn't going to be there to monitor the trade. I just entered the trade, put my levels in, left it alone. Okay. The only way I could do that was by taking an appropriate size. And what I mean by that is I made sure that my size was such that if I lost this trade, I wouldn't get my feelings hurt. Okay. It wouldn't blow my account. All right. It wouldn't even come close to blowing my account. I was totally comfortable with losing whatever I was putting on this trade. And that's how every trade should be. You should be 100% comfortable with losing the amount of money that you're putting up, right? You do not want to be over leveraging into your trades. Okay. And only you can really decide what over leveraging is for you. And the only way you're going to be able to trade with this level of confidence, as if it's a demo account, right, is by appropriately sizing in. All right. So, with all that being said, this is the actual trade, except for my target was actually a little bit higher than this. Okay. And this ended up being like a 1 to 8 RR trade, or however it is that traders talk about it. But you can see we have this little W pattern on the 5-minute chart, right? Right at that London Open, the first 5-minute candle that closes above that EMA, I'm getting in there. Okay. I might have gotten in just a little bit higher than this, but I'll show you my actual position in just a moment on my trading platform, right? But this is basically where I got in right there at the break of that EMA. My stop loss was actually tighter than this. It was like a 1 bar stop. Okay. And like I said, my target was just a little bit higher than this even. All right. So that was the trade. Is my actual entry here. All right. But you can see, I hope, what I'm talking about, right? So here's our open. Here's our close. It's a higher close than the open. So anywhere that we buy below that opening price is a good price, because price should be closing above that opening price, right? And you can see, if you're not monitoring it and you were just leaving it till the end of the day with no like take profit, target in or something like that, you could have potentially, if you held it all the way through this, you would have given back all of this. So, it's good to come back and check on your thing. I'm not advocating for just forgetting about your trades indefinitely, but I let this trade sit for 6 hours. Okay. That's probably the longest trade I've ever held since I went live trading. But this is the best way to do it. Okay. Let it run its course. You have a target, let it hit that target. Of course, you got to use your common sense. If it gets, very close and then looks like it's going to be reversing on you, just shut it down. Okay. Use your common sense. Right. Now let's look at some other charts from Wednesday. And I'm going to be going over different things with you. I'm not saying that every single one of these are like a best trade, A plus type of setup, but I want to use these charts as examples. All right. So here, we're looking at the gold chart, and you can see that we've had 2 previous days that have given us lower closes than the open. Okay, so just based off that, we might expect another day of lower prices. Okay, now you can see here. this market obviously gave us a lower close. Here's our open, all right? And this rectangle that I've highlighted, this price action that's inside of this box is the upper wick, all right? That is the portion of intraday price action that occurs above the previous day's closing price before continuing lower to give a lower close. And this is the London session right here, okay? We're gonna zoom in on this. That's the London session, okay? We're working the high. We're up here, we're retesting the Tokyo, the current high of day level that was put in place in Tokyo, all right? And you can see we have our M pattern right here going into the high of the day, all right? And we go lower. You could take that as an entry. As soon as we break the middle structure of that M, that could be your entry. That's your aggressive entry. And you would just be putting your stop loss at the high of the day. Just put it at the high of the day, all right? Adjust your lot size, make it something you're comfortable with losing, all right? And then target the opposite side of the range, which may only be here, all right? And what you can do is take off 80% of your profits at your target, okay? And then let the rest run, all right? Or just shut it down and don't be greedy. Don't worry about taking 1,000 pips, all right? Just take your 100 pips or your 200 pips and get the hell out of there. You know what I'm saying? Or you could enter this market more conservatively, more safely at the first convincing 5-minute close below that EMA, all right? So bam, there's your entry. And in this case, if it was me, I like to have a little bit tighter stop loss. So I might not put my stop loss all the way at the high of the day. Okay. I might put it at the high of this pullback right here. Right. Or maybe even a 1 bar stop and then let it ride. Okay. I'm taking a more conservative entry. I'm going to tighten that stop loss up. Okay. At least at some point, like maybe you can start off with your stop loss at the high of the day. Once we get the next couple nice candle closes down, then we tighten up that stop loss. All right. But you can see, even if you were targeting this anchor point of this pump, bam, you hit your target over here with no stress, bro. That's a good trade on gold, especially if you're sizing into this trade. All right. Now, here we're looking at oil. All right. The previous day was an inside day. That's a signal day, according to Stacy, correct? Now, for me, the easiest type of inside day trade that I can look for is the false break of the inside day type of trade. All right. And what that means is exactly like we see on this day. Here's our most recent low. This is actually not the low of the inside day. That low is like right here. All right. And here's our high of the inside day. You can see that this day opens right here, trades below the opening price, breaks out of the low of the inside day, going into the London Open, right? And then breaks the low of the day before that as well, right? And gives us this little squeeze down here. This is, let me make sure. Okay, yeah, this is our 5-minute chart, right? You can see we have broken out of that inside day low in the London Open. We reverse, we start going to the opposite side of the daily range. So here, it's the exact same thing. What I'm trying to impress on you is that if you have your lot size correct, okay, then you enter at the very first moment that your entry criteria is met, okay, which is that convincing close above the EMA on a 5-minute chart. And that happens right here, right in that bend of the EMA. Okay. Bam, you're in there. Your stop goes at the low of that day. All right. And you're targeting the opposite side of the range. So the high of that inside day. What a beautiful trade this is on oil, but you have to be able to enter with 100% confidence based on your lot size and knowing your setup, all right? And this is what we're looking for. It's exactly what I told you before. So Here's the high of that day. Here's the low of that day. Anywhere inside of that is a no trade zone. Okay. We want to wait for a level to be broken. So you can see here, this level has been broken to the downside as we go into the London session. So our criteria is met. We are in breakout. We're in our session opening window. All right. It's just the London session instead of the New York session. Then our entry criteria is met for a reversal trade from the low of the day, and we take that trade. Okay. And here we're looking at the euro US dollar. Excuse me, I'm going to take a drink. Here we're looking at the euro. All right. And I'm not exactly sure how the previous day closed. I can't remember right now. But you can see we put in this low near the end of that day, end of Tuesday, and we start pumping up from there. The market closes here. We chop sideways through the Tokyo session, okay, into the London session. London just barely breaks out of the high of the previous day before putting in a lower low on the day, okay, a lower low on the inside. It's a lower low on the inside because it's not breaking the previous day's low, but it is breaking the low of the current day so far, okay? So, bam, a lower low on the inside. This market pumps up going into the New York session. You can see we have this little head and shoulders pattern right here at the level. All right. We break out right at 8 a.m. We've already broken out. The third leg of this head and shoulders pattern is being put in place at the 8 a.m. open. All right. These Forex pairs, they can move a little bit earlier, but that is our pump and dump. Okay. We break out of the high of the day and reverse. We target the opposite side of that range, put our stop loss here at the high of the day, adjust your lot size so you're comfortable with losing whatever it is you're risking, and then walk away. Don't come back and look at this trade until your stop loss has been triggered or your profit target has been triggered. Okay. That's the next step for me. That's the next step for you, okay? Because you're here with me. Now, here is the UK 100. Now, this is sort of a different example, all right? Because typically, I would be telling you guys to wait for 9:30 before you enter a trade on these indexes, all right? But sometimes there is a special case when the trade looks perfect. It lines up perfectly, and it is before 9:30, okay? But still right around that 8 a.m. open, 8:30, okay, timing rotation. Now, I have to leave it up to you to decide if it's worth it or not to take a trade to break that rule, that 9:30 rule, all right? I have to leave that up to you. You have to decide if it's worth it because there may be times where you try that. You think that the pattern is there, you know, your setup is there, but it's just before the 9:30 opening window and it might not work for you. You might get hit one more time. It might go back up one more time and take you out. And then finally at 9:30 or 9:45, that trade actually happens. All right. So, like I said, I have to leave that up to you. But this was a picture perfect trade. It was just a little bit early, right? Now, what I mean is you have to figure out if it's worth it because you're breaking a rule. Okay. You're breaking a foundational, fundamental rule when you're doing that. All right. And we should know by now, you don't have to force anything. Okay. So if the trade happens too early, it happens too early. You don't take the trade. You have to just know and have faith that your setup is going to come around again. You will have the opportunity to trade. You don't need to take everything, no matter how good it looks. There will always be another setup. All right. So is it worth it to break your rules to get into an earlier trade? I don't know. You have to decide for yourself. Okay. Now here, looking at this market, okay, we have the low of the previous day. We have the high of the previous day. This market opens, puts in a slight low in the Tokyo session, and then immediately starts to pump up. Okay, we're pumping up above the opening price of the day. Okay, going into the New York session, we break out of the previous day's high of the day level. Okay, we're going sideways at that level. And here you can see our M pattern at the high of that day. We get our first 5 minute candle close, right where my entry is, this first big 5 minute candle, right? Bam, that's your entry. Your stop loss is at the high of the day. Adjust your lot size so you're comfortable with losing whatever it is you're risking, and target the opposite side of that range, right? And here we're looking at another long trade example on the Canadian dollar Swiss franc currency pair. Now, this one is slightly different, and I've also put the master pattern template on there for you to see. Here's our step one, our peak formation high. Step two, peak formation low. And then we have higher highs on the inside in that, I believe, Tokyo session window. All right. And then this market trades back down. It dumps one more time back into the previous day's low of the day level. We don't quite go all the way down there, but we retest the previous day's low of day level before giving us our reversal pattern and exploding parabolically to the upside. Right. Again, this is like a picture perfect dump and pump type of trade. All right. We would be entering because we've adjusted our lot size to the point where we are comfortable with losing whatever we're risking, right? We enter at the first 5 minute close, the first convincing 5 minute close above that 20 period moving average, stop loss at the low of the day, and we're targeting the opposite side of the range. And then we are walking away, right? And not coming back until one of those orders has been hit. Right? And I believe this is the last chart we're going to be looking at. This is the Great British Pound US dollar currency pair. Okay. So we had the previous day, Monday, dump down. Okay. That was our dump day. The next day, we get a higher close than the open. There's our first green day, signal day. Okay. Which means I am expecting the next day to give us a higher close than the open. Right. And you can see that on that day, I actually marked off the closing price for you with that dashed line there on Wednesday. You can see that we open and then start to trade below that opening price or below the previous day's closing price back into the previous day's range. All right. We are dumping down into the London open. All right. Trading back into that range before reversing. Okay. And you can see our first 5 minute candle closure above that EMA is right there. You enter immediately. All right. Here's our extended W pattern into the low of the day level. All right. You enter, put your stop loss in, adjust your lot size, all that good shit, and then target the opposite side of the range and walk away and let the market work for you. Let your money work for you. You understand what I'm saying? Now, I hope that this video makes sense for you. Okay. I hope that this makes sense out of those ideas. All right. This is how you are going to buy low and sell high. You need this sort of foundational understanding. This is just how the market works. All right. If you look at your charts, you're going to see series of green days and then a series of red days a lot of the times. All right. Like one of the things that Stacy says that we can be looking for is 3 days of breakout traders long, for example. All right. Now, that means we have 3 days that break the high of the previous day. Okay. So while that's happening, okay, that setup, that's a short setup. So we're looking for 3 days of breakout traders long, and we can get the short trade on that third day or the day after that. All right. So it's a short trade setup. So while the market is doing this, putting in the 3 days of breakouts, that's when we are on the front side of the move. Okay. We're on the front side of the move, meaning we're putting in higher highs and higher lows. All right. That means that the market is giving us higher closes than the open. All right. And typically we will be waiting through this for the short trade after that day 3. Okay. But you can also trade on the way up. There might be brilliant long opportunities in the session that you're trading if you know what you're looking for, right? So, and what you're looking for is the market to open. Okay. You have your first green day, right? Then you're looking for the market to open and at some point trade below the previous day's closing price, reverse in a session window. Okay. And then ultimately go and give that higher close. You can find your trades like that. So you can trade the front side of the move. Those might be your session scalp opportunities. Okay, you might take those with smaller size while you wait on that short trade after the 3 days of breakout traders, right? Another thing that Stacy says we're looking for in the playbook and stuff is we're looking for 3 lower closes into the lowest close of the week or the lowest close of the month. And this is a reversal setup. Okay, so if we're looking for 3 lower closes, then we're looking to trade long the next day, okay, which would be our first green day. So we can trade the first green day itself, and then we will be looking for another green day after that, right? But with this, you can trade those 3 days that give those lower closes, all right, because you're looking for the market to open, trade above the closing price of the previous day, all right, trading back into the previous day's range before ultimately reversing in a session window, putting in the high of that day, locking it in, and then trading to the opposite side of the range to put in that next lower close. All right. So I hope that that makes sense for you. All right. I want you to go back and look at your charts. Okay. Look at your daily charts. Find a series of lower days where we have like 2 days even that close lower in a row, 3 days, 4 days, 5 days, and look at those wicks and then zoom in on those days on the 15-minute time frame and inspect the price action that is that wick. That means if you are looking at a day that gives a lower close than the open, the upper wick of that candle is any bit of price action that occurs above the opening price of that day. Okay, that's the price action that makes that wick. So go inspect that price action there. Go inspect what time it is. What type of reversal pattern is it? You know, on there on the 5-minute chart. Do you have an M at the high of the day? Is it the A top reversal? Inspect those patterns, right? Go back and look, study this. This is going to help you. You're going to become a more well-rounded trader, someone with a very simple yet powerful view of the market, understanding of the way the market moves. All right. Anyway, man, until next time, I hope you continue to free your mind.